Hi, welcome back. You're with Trading Hour. Let us talk about some stocks which are buzzing in trade. Amongst them is SBI Cards. That's on our radar on the back of the company's performance in August. Abhishek has done the data crunching and he's here with all the details. Abhishek.
For the month of August, RBI's credit card data do suggest that SBI Cards performance is better than the industry average. So total cards have grown by 2% on a month-on-month basis, while, for the sector, we have seen a decline of 2.8% month-on-month. Total spends have increased by 1.24% month-on-month, while for the industry as a whole, it has declined by 3% month-on-month. However, average spends have declined by 0.8% month-on-month, which compares to a decline of close to 0.2% for the industry as a whole. So in terms of card issuance, they have gained market share for the first time in last 3 months. And in terms of, market share in spends, they have seen a first time market increase in last 5 months. In spends, their market share is now at 17.43%. This compared to 16.7% that they had in the previous month. So overall, a good data coming in for SBI Cards, and the festive season ahead is giving the stock, a cheer in trade today.
Thank you very much for that. Another important stock is GSPL. That's buzzing in trade. The management met ICICI Securities, and Sonal joins us with key takeaways. Sonal.
Well, GSPL said that the demand outlook in the near term is not so strong. However, in the longer term, the expansion plans and the tariff adjustments could mean that earnings remain stable for the company. They said that demand prospects are muted in Gujarat across all the sectors, which also includes the power and the city gas distribution space, from where the largest amount of volumes come in for the company as well. The contracted transmission flows have shrunk to less than 27 MMSCMD for the company in the second quarter, which is usually around 30 to 34 MMSCMD for the company, and they are unlikely to see much traction in the near term as well. However, on the flip side, use or pay charges and trading of cargoes at a price lower than the spot LNG prices at $30 per MMBTU. Remember, spot LNG prices in this environment are around $45 to $50 per MMBTU. So a lower purchase price could actually support earnings for the company. They have aggressive expansion plans and are looking at investing 2,000 crore rupees in various pipeline expansions. However, the tariff and expansion programs that I just spoke about is something that could provide fillip to earnings in coming years as well for the company. But on the back of near-term outlook being muted, ICICI Securities has cut their EPS estimates for FY23 and FY24 by 11% and 5%. They have a buy rating on the stock with a target price of 375 rupees per share.
All right, Sonal, thanks very much for that. Let's now talk about where the markets look to be headed and what should be your portfolio positioning. Shyamsunder Bhat, CIO at Exide Life Insurance, joins in now. Hi, Mr. Bhat. Morning. Thanks very much for joining in. So in the near term, the outlook appears to be cautious for you and I guess for all market participants right now. But, what should a person who has money to deploy now do? I mean, should they wait in cash or should they continue, staggering their investments? And therefore, which are the places to look for fresh investments now?
Thank you. Good morning to all. So the answer to your question would be that for someone who has money to deploy, a better strategy would be to deploy it over the next few months, because longer term outlook for Indian equities is definitely positive. The next 1 to 2 years, clearly, there is some amount of concern primarily on the valuation front, because while we may continue to do relatively better than global markets, directionally, the kind of environment we are in from the liquidity and global growth perspective may not really spell good news. But equities, as we all know, are one of the best yielding longer-term assets from a post-tax perspective. So this opportunity for investors over the next few months clearly appears to be, it definitely appears to be a good opportunity to stagger investments.
But what is it that you expect in the next few months? What do you mean by volatility? Should we expect significant downside or just some more time-wise correction? Because we haven't seen a big fall commensurate with what's happening globally.
True. So actually, we've seen, if we take the starting point as of October last year or so, since when the market started correcting, we've seen actually 3 or 4 moves of almost 10% in both directions, and on a net basis now we would be close to being flat, on a yearly basis. From a perspective of performance versus global markets, given the advantages that India has in terms of the political stability, the growth aspect, as well as relatively comfortable forex reserves, though of course we've seen $100 billion getting shaved off in the last over the last year. All this will play a role in India being one of the favored markets. To your answer on in terms of volatility, so in both directions. So it's not that we may see a market which is continuously trended downwards. So we may actually be in for some more time correction, very similar to what we saw over the last year. Because if we consider that we are actually flat exactly at the same level as where we were last year, effectively we've had a time correction. But in the interim, of course, we've had big moves in both directions.
So, Mr. Bhatt, what are the sectors that one should be wary of at the moment? I mean, where do you not step at all?
So we do not really have any particular sector that we totally avoid, but yes, we do have an underweight position in most of the globally oriented sectors, primarily due to the uncertainty in terms of the growth aspect as well as the pricing aspect in terms of global industries. So whether it's oil and gas, whether it is metals, two clear sectors which are where we are underweight. And we are also marginally underweight on the IT sector, though of course, given the kind of significant underperformance in that sector over the last few months, we may not see much downside in the IT sector from here. At the same time, while we are positive on the domestic economy, there are sectors on the domestic side also where we are underweight. Consumer goods, for example, which is favorably placed in terms of being able to withstand the current environment, but already baked into the valuations of many of the stocks. So we are underweight there. And the auto sector, which has actually done extremely well over the last few months, got the tailwind. We've got the tailwind for that sector in terms of a strong demand, as well as now cooling commodity prices. But again, the valuations appear to have factored in a lot of good news here. So we may look to add this sector only, at lower levels.
You must interact with a lot of foreign investors as well. We were hopeful that the FII's flow tide would have reversed after being, net sellers since October. We've started seeing early signs of FI inflows pick up, but once again, with the dollar strength, the rupee weakness, the FIs have started selling in the Indian markets, in the cash market, in equities. What is it that you expect and you're observing?
Right. So I'd like to answer it this way. The actions by the FIs are can be typically because either it's a reflection of their view on a particular market, and second, it's a reflection of their underlying investors. So clearly, if you have underlying redemptions from the investors in these foreign funds, there would be a need to liquidate. And then, of course, the FIs will need to decide between the various markets that they are in as to where they would like to take money off the table. On this front, clearly, because India has done far better, not just in terms of the index, but also in terms of the currency. So while we've seen a sharp depreciation in the past few days, on a relative basis, our currency has still performed far better than most other currencies. So to that extent, from the FI portfolio perspective, the India portfolio would have done much better than most of the other markets, which possibly is one of the reasons for taking some money off the table. But at the same time, given that over the next 2 years, the competitive positioning of India is likely to improve considerably, in future allocations in the new calendar year, we may actually again see India being given a higher weightage than what we presently have. And hopefully by then, the time correction also would have enabled the markets to roll over to one more year forward. Because as of now, given that on a 2-year basis, we are at 18 times for a 12 to 13% earnings growth, there doesn't seem to be that much of upside in the index per se, while obviously individual stocks or sectors, we still see upsides.
Mr. Bhatt, thank you very much for your time today and for talking about the market outlook as you see it. A quick break. On the other side, we'll talk about the currency. The rupee has recovered after a 3-day fall. What's behind it and where could things trend from here? So all of that is lined up next. Stay tuned.